What is up, ladies and gentlemen? It is Dividend Grinder. Today, November 29, 2018. It is a Thursday. I don't think I've done a Thursday video in a long time. Anyway, today's discussion is inflation. And before we get into that, just a little update on how the portfolio is doing. Obviously, the past 2 days in the market have been awesome because Fed Chair Powell has said that the interest rates have been lower than neutral. So anytime you say lower rates and you're the Fed chair, I should say, the market's going to love it. Anytime they talk about raising interest rates, which has to happen in a normal economy, but anytime they discuss raising it, the economy hates that. The market hates that, and prices go down. But the past 2 days have been enjoying a nice little surplus from him saying it's been lower than neutral. So in terms of M1 finance standards, the portfolio is up 4.5%. If we go into holdings to see the true percentage, it was red 0.5 to 1% this week, and now it is at a positive 0.63%. Gladstone Commercial Corp, the top holding at 70% of the portfolio, is doing well at 0.66. As you can see, highly correlated to how the overall portfolio is doing. 566 shares in Gladstone Commercial Corp, giving me a little bit of, if it was to go ex-dividend tomorrow, I would get $70.25-ish cents, maybe a little bit more. I have to check. I didn't update it until yesterday. But a touch over $70 in dividends from Gladstone Commercial Corp. The other winner in the portfolio has been Clorox and Procter and Gamble. They've been doing awesome in terms of appreciation since when I bought them. And as you can see, the others are just a mix of both red and green. McCormick, look at that. I didn't even notice that one, actually. 20% up from McCormick, but I had my eye on Procter & Gamble and on Clorox. But enough of that. Let's get into inflation. Now, before I say any of this, let me reiterate, everyone who watches me knows this. The channel is for entertainment. I am not a market professional. Do not take any of what I say set in stone. But inflation. Okay, so let's look at this. So it's just inflation in the United States year over year since 1929, but we're going to look, more modernly. So let's go back to 2000. So you can see 3.4%, 1.6%, 2.4%. So inflation hovers around 2 to 4% every year. I think the national average back in 2014, it was quoted at like 3.14%, around pi, that number. So first of all, what is inflation anyway, if you don't know, if you have no idea, if you've never heard of inflation or what it is? So it's basically just a general rise in prices for that country. It's the Consumer Price Index, the CPI, steadily raising. Simply put, if a piece of furniture costs $500, the next year it might cost $505. It's just natural. It's the weakening of the dollar. It's inflation rising. Everything just costs more, essentially. That's the easiest way to look at it. Obviously, I'm talking very, very, very high level, but that's just the basis of it. It's the prices of everything goes up. Something that cost $1 in 1950 is going to cost way, way, way more in 2018. That's inflation. So a lot of arguments against dividend investing and trying to retire early and living on dividend income is that, okay, but you're not factoring in inflation. Now, there's two kind of, I would consider, bugaboos when it comes to dividend investing. One is taxes. There's always questions on taxes. You're going to have to pay this up front. Is it really worth it, dividend investing, if you get taxed so heavily? The other is inflation. Is it worth getting that yield if inflation cuts into it a large majority? So let's just look at my portfolio just to compare it, because obviously that's the one I'm working with. That's the one I want to retire on. So let's just do some research here. And if we click on my pies and we go to the aggressive dividend portfolio, so the dividend yield right now is 6.3%. And to make this very simple, let's say the average annual rate of inflation in the United States, where I live, is 3%. So if your dividend yield is 6.3% annual and your inflation rate is 3%, all things equal, you will make an additional, or I shouldn't say an additional, you will be on top 3.3%. Just naturally, you're beating the rate of inflation with your yield. Now, obviously, if you go back, there has been years where the inflation rate has been very high, 12%, 13%. It has inflation has been driven down dramatically in the past 20 to 30 years, as you can see, starting with about the 1990s as we had a 6% 90, but ever since then we haven't had one that's spiked over 4.2%. So we could be in line for a big jump. We could have a huge recession and inflation could hit us hard, but generally speaking, the dividend yield of this portfolio, if it were to remain consistent and no one drops their dividend or whatnot, this would always beat the average rate of inflation increase. So it's kind of a moot point. Like, yes, does it cut into it? Obviously. And that's where a lot of growth investors would comment in. Like, I'd rather try to make 20% in a year. Oh, I see my internet just cut out. Hopefully that doesn't affect this video. But I see a lot of people saying, hey, you know, I made 20% in growth stocks and now I've beaten the rate of inflation way much more than your dividend income can. And yeah, that might be true, but once you sell a stock, you don't have it anymore. And, you know, it sounds dumb from a higher level, but you have to realize that it's like, once you're getting dividends, you don't have a real reason to sell unless a major event happened. Maybe they got acquired, maybe they jumped 50% for some reason, maybe they had a, you know, bankruptcy hearing, something absurd happens. You know, when you invest in high yielding dividend stocks, there's really no incentive to sell for a long time. And if you're holding for a long time and it's a high yielding dividend stock or ETF or whatever it is, chances are it's going to beat the inflation rate. Now, there are many very good dividend paying stocks that have lower yields, such as, you know, you can look at like 3M. I don't think Johnson & Johnson's is too high. I don't think Apple's is too high. And you could say, well, that doesn't beat the rate of inflation. But yeah, they also have good capital appreciation too. So it honestly depends on your viewpoints on inflation. Do you really factor it in to your overall investing that much? And, you know, if you honestly do, if you take inflation way more into account than I am obviously showing, let me know in the comments below. This isn't a subject that I'm like, oh my God, why do you care about inflation, blah, blah. No, I'm honestly open-ended about this. This is just my opinion that inflation doesn't play too much of a factor into my goals with this portfolio. Because at the end of the day, yes, inflation is inevitable. It's like death and taxes. Inflation's going to happen. Everything's going to rise in price. But if I'm 50 years old and I own my house, like I don't have any debt on it and I don't have any debt for my car, then, you know, my dividends could easily cover my living expenses. And that's the whole point of this dividend portfolio, is that someday the dividends actually pay for my living expenses. And, you know, you have to consider, well, how much of the living expenses am I actually going to have to pay? How much of my living expenses is actually affected by inflation? So yeah, you know, a cup of Starbucks coffee 50 years might be $15, but at the same time, I don't need it. It's not part of my living expenses. Now, you could argue that the way that the 6% yield in 50 years might not be enough to cover it, the inflation rate and the rising prices. I would just argue that, you know, what are your living expenses? Do you live a frugal lifestyle? Do you live a flamboyant lifestyle where you need lots of discretionary income? That's just not my lifestyle. But if you do need a lot of discretionary income to fund a lot of things like entertainment for yourself, then yeah, you might have to beat inflation a little bit more than how I do in my portfolio. I think a 6% dividend yield beating a 3% average United States inflation rate is good enough for me, and it's good enough to consume my living expenses in 20 some years, and I think it's all going to work out. And if not, well then at the end of the day, it's a large sum of money. You know, I'm putting daily money into this portfolio. So if it doesn't work out, if inflation does kill me per se, what's the problem? I have a large sum of money that I can just take out and use. I mean, if I put in the bank account, aren't you theoretically losing money then because of inflation? Many people have different mentalities on inflation. I'm very curious to hear yours, so always feel free to leave a comment down below. I love hearing comments and different perspectives on this one, because inflation, in my opinion, is a very open-ended topic when it comes to investing. Many people don't even consider it, and many people say, you need to factor it in when considering long-term investing. Let me know your thoughts down below. Just a reminder, if you want $20 referral link for signing up for M1 Finance, tomorrow, the end of November, is the last day. I saw an email from M1 Finance, maybe they extended it, but the end of November, which is tomorrow, try and get that referral link going. You can get $20 and then it'll revert back to its usual 10. If you're interested in investing in M1 Finance, I leave a link in the description down below. And if you're interested in seeing this portfolio, the aggressive dividend portfolio, and the daily dividend portfolio, I also leave links in the description for both those down below. I will see you guys in the next video. Let me know your thoughts on inflation.